Welcome to The Explainer. There's so much noise out there about the Indian stock market, right? All this hype, confusing jargon, it can be a lot. So today, we're going to cut right through all of that. We're going to forget the get-rich-quick stuff and build a real, solid understanding of how it all actually works, right from square one. So, let's get into it. And let's kick things off with what is, without a doubt, the single most important idea you need to get your head around. The stock market, it's not some kind of magical casino. It's not abstract. It's a place where you can invest in real, actual businesses. So the key thing here, the big takeaway, is that you're not just gambling with numbers on a screen. No, you are literally becoming a partner in that company's story.
So what does it really mean when you own a stock? This is like the foundation for everything else we're about to cover, so let's make sure we're all on the same page.
The beautiful is how simple this idea is. A stock, or a share, or hisadari. It's exactly what it sounds like. It's just a tiny piece of a company. When you buy a share, you are literally buying a little slice of that business. You become a part owner, a partner. And that means whether that business soars or, well, if it struggles, you're right there with it. Okay, that makes sense for the huge companies we all know, right? But how does a business even get to that point? I mean, how does a tiny little idea, say a local pani puri stall that has the best recipe in town, grow so big that it can offer shares to millions of people? Let's actually walk through that journey. So, pretty much every giant company starts small. Our pani puri stall, for instance, probably gets its first bit of cash from friends and family who believe in the idea. Then, once it starts getting popular, it might catch the eye of professional angel investors who want a piece of the action. And to go national? Well, that's when the big guns come in, venture capitalists. See the pattern? At every single stage, they're trading a little bit of ownership for the money they need to grow. And that all leads up to the final, massive step. And that final step is the big one. The IPO, which stands for Initial Public Offering. This is that huge moment when a private company finally goes public. It's the very first time it sells its shares to absolutely anyone, you, me, anyone, on a stock exchange. And why do they do it? Well, it raises an enormous amount of cash that lets them chase their biggest, boldest plans.
And this brings up a really important point. There are actually two markets. The IPO itself, that happens in what's called the primary market. And here, the money from selling shares goes straight to the company. But what about all the trading you see on the news every day, all that buying and selling? That's the secondary market. And in that market, it's just investors like us trading shares with each other. The company itself, it's not really part of those transactions.
All right, so now the shares are out there. They're in the wild, being traded back and forth on the secondary market. But hold on, there are thousands of companies out there. How on earth do we make sense of all of it? How do we get a quick snapshot of how the market is doing overall? Well, there's a pretty clever solution for that. The answer is something called an index. And honestly, the best way to think about it is to use the TRP analogy for TV ratings, right? It's totally impossible to know what every single person in India is watching at any given moment, so they just survey a smaller sample of households. The stock market does the exact same thing. Instead of trying to watch thousands of companies, an index just tracks a sample of the biggest, most important ones to give us a general vibe of which way the market is heading. So here in India, there are two big ones you're going to hear about all the time, the Sensex and the Nifty. The Sensex keeps an eye on the top 30 companies listed on the Bombay Stock Exchange, the BSE. And the Nifty 50? Well, that tracks the top 50 on the National Stock Exchange, the NSE. So whenever you hear someone say the market is up today, they're almost always talking about one of these two. Okay, but who are all these people actually doing the buying and selling? Well, you can basically break them down into three main groups. First, you've got the retail investors. That's us, everyday folks. Then you have the heavy hitters, the institutional investors. Think mutual funds, insurance companies, the ones trading massive amounts of shares. And finally, you've got the advisors and rating agencies, the folks who spend all their time analyzing everything and, well, influencing what everyone else does. All right, let's pause here because we've come to what is maybe the single most important part of this whole conversation. It's about a mindset shift. Because there is a world of difference between being an investor and being a gambler. And getting this right, it's absolutely key if you want to build wealth sensibly. First things first, let's talk about expectations. You see all that stuff on social media, right? Double your money in a week. You need to just ignore all of that, seriously. For a smart long-term investor, a healthy and realistic return is somewhere in the ballpark of 15 to 20% a year. This isn't about hitting the lottery. It's about letting your money grow slowly and steadily over time. So what really separates these two mindsets? Well, an investor, and that's what we want to be, they focus on the actual business. Is it a good company? Does it have a bright future? They're thinking in terms of years, even decades. They're a partner. A gambler, they couldn't care less about the business. All they see is a squiggly line on a chart, and they're just betting on which way it's going to wiggle in the next few minutes or hours.
Okay, so if we're saying that day trading and chasing penny stocks is basically gambling, then what's the real path? What's the proven way to actually build wealth with the stock market? What is the real opportunity we should be looking at? This is it. The real magic, the true power of the stock market is that it gives you, me, any of us, the chance to become a part owner in the best companies in India. Think about that for a second. It means you can have some of the most brilliant business minds in the country, a Ratan Tata, a Mukesh Ambani, working to make their company more valuable, which in turn grows your money. Why? Because you're a partner. So if there is just one thing you take away from all of this, let it be this. Change the question you're asking. You've got to stop asking which stock is going to make me rich tomorrow. That's the wrong question. The real powerful question you need to ask yourself is this. Which great Indian business do I actually believe in? Which company do I want to be a partner with for the next 10 years? When you start asking that question, well, that's when you've truly started your journey as an investor. And this brings us to a classic trap for beginners, the penny stock. The thinking goes, hey, I can buy 500 shares of this cheap stock instead of just one share of that expensive one. But think about it. Would you trade a 100 rupee note for 101 rupee coins just because you have more of them? Of course not. The value is the same. What matters is the percentage growth on your money, not how many little pieces you own. It's all about quality over quantity.